In Europe alone, there are 1,400 new neobank payment providers and fintechs that have sprung up since 2005. As of 2016, they had managed to make 58 billion euros of annual revenue, equal to between 6 and 7% of the industry's total. Some examples of these are N26, a Berlin-based digital bank founded in 2015, which has signed up 3.5 million clients in 24 countries. It also launched in the US and has attracted a $3.5 billion valuation. Revolut is another example. It's a UK-based fintech founded the same year as N26, which has amassed 6 million customers and a $1.7 billion valuation. There are many examples of these startups, and what's even more impressive is the fact that their services are increasing as much as their valuations. Take for example Monzo, a UK fintech that started by offering a prepaid debit card, then a current account, and recently moved into short-term loans. But the extent to which technology is entering the banking industry is not limited to these startups. Indeed, big technology groups and notorious companies such as Google, Amazon, Facebook, and Apple are also entering this financial services industry. Amazon's credit card and business loans are aimed at boosting its e-commerce business, while Uber Money is providing credit cards, debit accounts, and money tracking tools to serve the company's taxi operations, while Facebook said its Facebook Pay service will complement its messaging tools. Facebook has an electronic money license in Ireland, and its WhatsApp messaging service is building a payments offering in India. And Google has become the latest big tech firm to move into banking by offering current accounts with a new effort, while Alibaba and Tencent have become dominant operators in China's $5.5 trillion payment industry. Indeed, in China, tech firms have been quicker to move into banking. This was motivated by the need to fill in gaps left by traditional finance industry that created hurdles for their businesses, an issue that was less pressuring in the US. As a result, big tech payment services provided by the likes of Alibaba's Ant Financial and Tencent's WeChat account for roughly 16% of China's GDP, compared to less than 1% in the US. As a result of this technological revolution, traditional bigger banks have grown used to conceding market share to startups. A notable example to prove this point is in the US mortgage market. America's top three lenders, Wells Fargo, JP Morgan, and Bank of America, have seen their share of home loan fall from a peak of 49% in 2010 to just 19% in the first half of this year. So how is the market adapting to this change, and most importantly, how are traditional banks dealing with the new rise of digital banking? Well, there are multiple ways in which banks have answered this threat. Some banks have chosen to answer it through their own initiatives. Take for example Goldman Sachs, who 3 years ago launched a consumer digital savings and lending operation. It named it Marcus after Goldman's 19th century founder. The new digital operation has accumulated more than $26 billion in deposits and lent $3 billion to customers, generating over $1 billion of new revenue for the bank. Another example of this is Dutch bank ING, who adopted a similar approach when it launched Yolt. Through the service, it offered customers a way to collate all their financial information in one place and track their spending, and get prompts to save money on, for example, utility bills. Yolt has signed up more than 400,000 users in the UK and recently announced plans to expand into France and Italy. Following on from this initiative-led approach, some banks have pursued a strategy of diversification. Royal Bank of Canada, for example, unveiled a strategy to broaden its platform to offer diverse services that range from registering a startup company to helping people rent their house on Airbnb. This branching out technique has also been incorporated by Barclays with its offers to store important documents such as passports and birth certificates on the cloud for the customers. Another very important strategy is that of partnerships. We have seen many cases of these, especially between tech firms working with traditional banks. Notable examples are Google working with US partners including Citigroup to offer accounts, or Apple, who has teamed up with Goldman Sachs for its Apple Card and wallet service. Another very important example is the partnership between JP Morgan and Amazon, which would bring together the US's biggest bank and the largest US e-commerce company. Aside from the increased revenue, there is also another reason for which big technology groups are moving into the finance sector, and this can be led back to Google and Facebook's ability through this new finance sector to track information for their advertising businesses, helping specifically to see what ads lead to purchases. So having considered this, it is essential to also consider how digital banking could impact on digital currencies. As we mentioned before, China has earned a lead in the sector, and it is now aiming to be the first country in the world to launch a digital currency. Its central bank has been researching this possibility for 5 years. However, we still do not know what technology will be behind its digital currency. Some analysts believe it will be blockchain, and just to clarify this point, this is a technology characterized by a decentralized database stored across a network of computers, where all transactions are public and no single user has permission to alter other people's accounts. In this scenario of digital banking, the one to suffer would be retail banks. Indeed, if people can hold their deposits of electronic cash directly at the central bank, retail banks would inevitably be cut out. However, the head of digital currency research at the Bank of China stated that the new currency will be issued to existing financial institutions. That means that the bank would then distribute it for use by customers, much as a physical currency is issued now. But what are the benefits of a new digital currency like this one? Well, in the long term, the People's Bank of China said that this new digital currency could be used to improve the efficiency of transactions across the financial system. And officials also said that it could help battle money laundering, illegal gambling, and terrorist financing. However, this new project has been criticized, and some have argued that replacing cash with a trackable digital currency poses a serious threat to privacy because it will give the central bank a view of everyone's transaction. At this point, you might be thinking that this new Chinese digital currency sounds very similar to Facebook's Libra project. Indeed, Facebook has been trying to launch its own digital currency, and Mark Zuckerberg has recently warned the US Congress that if the company's project was blocked, it could lead to China overtaking the US in financial innovation. However, there are two important differences between China's project and Facebook's Libra. Libra is likely to be backed by a basket of currencies, such as the dollar and the euro, while China's digital currency will be purely backed by its own yuan. Secondly, Facebook's explicit intention is that Libra will be used around the world, globally, while China's digital currency will fall under its own controls, which will restrict how much can be taken out of the country. We hope you enjoyed this video, and thank you for suggesting it in our poll recently. If you did, please leave a like, a comment regarding your thoughts, as we'd love to have a discussion about this topic, and we'll see you here for the next one. Remember to subscribe so you never miss an episode, and thank you for watching.